Hello, everybody. My name is Bob Klefsis. Welcome to the All-Star Financial Quarterly Review, first quarter 2015 webinar. The dollar and jobs continue to surge. So when we look at our newsletter, we try to copy our newsletter relative to the webinar. Gives you a chance to follow through either by reading it or listening to it. The first thing we like to comment on in the newsletter would be Bob's Corner. I used the title today about kind of what's going on, what the heck's going on. The economy and the oil and the dollar, all of those things are changing. We've had 3 attempts really at quantitative easing. They've put $4 trillion into the concern. We've got 200 plus jobs over the last 12 months, 250,000 plus jobs the last 6 months, and now we have a disappointment in April. So again, do we need quantitative easing 4 will be really the big question. The other thing that's on the topic in top of everybody's mind would be the Arab nations playing chicken with us, and the idea that, hey, they have brought so much supply to the market that the prices have come down, and obviously the United States has been hurt because of that. Their oil and exports for the U.S. I think are going to be probably hurt a little bit too. When we look at our market overview, we really are going to talk about 3 things today, and that's the foreign stocks lead really as a title, the U.S. economy improves, and then bonds have obviously their play in the equation too. But predominantly overseas stocks won the race this last quarter. We saw the U.S. dollar continue to strengthen, which is not as good for U.S. multinationals when they're trying to export with a higher cost of doing business. We do have Europe and Japan, though, benefiting, and that benefit is obviously the idea that the dollar is in their favor. Europe has also put together a great stimulus program, quantitative easing 1 for them, and they're copying the U.S., and hopefully that's going to work. Again, jobs have improved over a 6 and a 12-month time period. The scare that we have is that is it going to continue to improve? Increased spending, will that lead to increased spending? And we think it will lead to job growth and interest rates going up or down. That's going to be the big question. Bonds, on the other hand, I put that on in the market review because we feel bonds are going to play an important part of people's portfolios. They could either be negative or they could be positive. Looking at the U.S. economy, I would define as really steady and moderate growth. We saw those great numbers in jobs in February, 5 million jobs still opening wise. Unemployment is at 5.5%. We've had some soft patches, however. GDP is only still at about 2.2%. Personal savings at 5.8, but personal spending's at 3.6. So that means that people are saving and not spending as much as they probably could. The housing concern for us still is out there. We're still about 14% below where we once were in the 2006 highs. When we look forward for the economy, we can see again a scare of are jobs going to continue. The numbers just came out 2 days ago that in March it was 136,000. That's a little bit of a big hit. GDP is projected by the end of 2015 to be about 3.5%. Corporate spending on the rise. It's about a 17% rise from last year at this time, which is good because we need corporations to kind of take over for the personal spending. And we have a great thing that inflation has remained low, relatively low, and interest rates are going to have to stay low on the long end of the equation too to incite the real estate market. When we look at the bond market, again, I think the bond market and the 10-year Treasury we see has been under 2%. It's been as low as 1.7 and a range over the last 12 months, 1.7 to 2.5. U.S. government bonds for the quarter did pretty well on the Barclays aggregate. It was up about 1.6 because, again, interest rates did come down on the 10-year Treasury. Barclays credit is up about 2.2 for the quarter. Government municipals about 1.6. Foreign bonds were hurt again by the strengthening of the dollar. The global bond market lost about 1.9% on average. Emerging market bonds were up basically because of the drastic downturn they had last quarter. because of oil and what was happening in Russia. So again, they bounced back. I think we're going to see a lot of bouncing for bonds looking forward. So what will happen with the 10-year Treasury is a bit uncertain. It could increase. The dollar strength obviously helps foreign investors. So that could decrease interest rates with the demand for interest rates. Right now, the U.S. bond market is the highest interest rate paying bond market around the world. So that really benefits us and obviously brings in those foreign investors. Credit bonds, the quality is still good. Spreads have fallen, so there's not quite as much total return there. And the potential energy downgrades are going to perhaps hurt credit bonds and high yield bonds. But the key will be staying diversified really in the bond market. If we look at the domestic stock market and we look at kind of what led, small caps led after large caps led last quarter. Small caps in the first quarter of 2015. Biotech, the tech sector obviously helped also. But again, when we look at kind of the whole flow for the quarter, U.S. stocks started very negative, but basically climbed to about a 1.8% positive for the last 2 months of the quarter. And we're looking at seriously a 6-year bull top. You know, in March, it's our full 6 years of upside. Does that have any vulnerability? Will remain to be seen. Some of the U.S. indices, you can see that the Russell 3000 was up, the broadest market indicator for us, about 1.8%. Large cap stocks versus mid caps versus small caps. Small caps obviously won the race. Mid caps were second at 4%. Large caps didn't do quite as well. So again, and one of the reasons why small caps did as well as they did is that basically the boost in the consumer spending happens and affects smaller companies first rather than second. Large companies are down the line a benefactor of greater spending. And they're not as reliant on overseas, where we have a rise in the value of the dollar. Some of the large companies with exports are being hurt right now because of the cost of doing business. You can see on the far right, we saw large caps growth outperform value pretty significantly. Leading sectors, 6.5% on the consumer, healthcare side. Consumer discretionary, 4.8, telecom, 1.5 positive. We did have some negatives on the utilities, energy, and financials. So again, a better picture of that. What's going forward going to be the case on the domestic side? I think things can still be positive. We see earnings that are up really in all of those sectors: consumer, financial, healthcare, technology. Long-term rates are lower, so again, that's going to help the business and the cost of money. We do have some negatives though. Value stocks are now overvalued, where everybody pushed to buy the dividend-paying stocks, which are value stocks. They've become overvalued right now. Growth is our sector of favor when it comes to value versus growth. The energy sector obviously hurt, being down 60%. And again, we're at the top of the market. Does that create more volatility or less? And obviously, in our minds, it's more volatility. So going forward, we have some negatives. Again, the last thing would be the strength of the dollar and what burden that has on large exports. If we look at the international markets, the developed markets really rallied very well. You can see quantitative easing really work in Japan and Europe. Again, they copied us. Japan was up a whopping 10.1%, Europe 3.8%, ex-Asia, or Asia ex-Japan up 4%. So again, the dollar strengthened and hurt a little bit when you repatriate if you own international stocks as a domestic stockholder. So you repatriate that back to the dollar, you lost about 7% on the international side of your portfolio. So again, we believe that's going to settle down though. Right now, the dollar to euro is pretty even. We saw the Morgan Stanley Composite Index of EFI, Europe, Asia, Far East, up 4.9. Morgan Stanley Composite Index of Emerging Markets up 2.2%. Looking forward to that, we would suggest that the internationals are are going to continue to outperform the domestics. Europe is still a best buy around the world. We've got a 15 to 30% undervaluation compared to the U.S. Last quarter, it was about 20 to 35%, so we've seen a 5% improvement there. Euro earnings are going to be better in 2015. They're projected to be somewhere between 10 to 15% growth. In the U.S., they're projecting probably 4 to 7% growth. Japan and China, as we talked about, they're transitioning not only politically but also when they talk about how their money supply is run. The quantitative easing one is going to be very, very valuable, and I think that people are going to bank profitability on that, just like they bank profitability when we started QE1 in the United States. Emerging is still the best asset class. It's cheap. Energy's hurt it, so it's gotten cheaper. So again, but we still think as value players, you want to be international. Real quick summary. Again, we're looking at the bull run of entering the 7th year of a bull run. Does that make things overvalued? I think by nature, yes. There are a lot of pundits that say that we had a deep enough recession that we can have a longer bull run. And a bull run of 7 years is already kind of unprecedented, but they believe that that might happen. Not so sure. We think that there's a watch list that you want to be concerned about. There's 5 issues. The dollar, could that continue to hurt U.S. exports? Job growth, is it peaking? Interest rates really can't go lower. So when interest rates go up, bonds go down. Stock valuations aren't cheap in the U.S. And inflation. There's no issue right now, but how long would it take for inflation to be an issue? Page 5 of our newsletter, we focus on something that really is a relevant information piece for our clients that we feel would benefit them. We're focusing on the cyber fraud. I know a lot of you probably are thinking about that. What happens and could I be vulnerable? 5% of all adults fall victim, so there is vulnerability out there. I don't think that that's any question. Tech advances to protect you on the financial side are really, really good, but so are the bad guys at beating those. It cost almost $21 billion to U.S. Investors, not investors, but U.S. citizens last year in that type of fraud. There's 3 common ways. The malware is really where they're attacking you through a software that gets into your computer and your hardware. The phishing and talks about really an email process that has really been focused more on the financial industry. So both of our discount brokers, Fidelity and Schwab, have amazing walls that they've built to not let people get in. And then the social engineering, and that's probably the hardest thing to protect from, because again, you'd like to put things on Facebook. But 5 simple tips basically for your future. Keep your machine clean. Don't get any viruses. Use that antivirus software that you pay for. Update it. Do all those things. Create it. Good passwords. You know, that again is going to outsmart the other guys. Lock your mobile devices so you don't have to be worried about people stealing those types of things, or if they steal, that they can grab stuff. And then censor information online. Again, don't necessarily have to tell everybody what's going on in your life. On the web browsing also, only go to secure websites. Again, a protection that I think you're going to benefit drastically for. So the last page of our newsletter, we've over the last year put it just for fun, and it's been great. The Red Cow is our recommendation for a great restaurant. It's voted one of the top 50 restaurants in Minneapolis over the last year. Great American food cuisine from all around the world. Also, he's a great recipe guy. Our recipe comes from Trisha. Trisha's president of First Impressions. It's her layered taco dip in honor of Cinco de Mayo coming up fairly quickly. And quote of the quarter: as a team, All-Star Financial, we want to talk about kind of talent winning games, but teamwork and intelligence wins championships, and that's our goal for us. Is what we want to win the games. We want to grab some singles, but we also want to win the World Series. I want to thank you guys for your continued support. Remember, we grow as you grow with the great referrals that you have for us. You have an opportunity to reduce your fees and your costs drastically every time you give us a referral. And again, give us a holler when you have a chance. Got 9 great team members here, and would love to be able to not only help you as a current client, but help anybody else that you have as a potential referral. So have a great day, guys. I appreciate your time. Rather than reading the newsletter, if you can at least listen to the webinar before you come in. It's kind of like in college where you have your syllabus. You should be reading it before. It makes a lot more sense when we talk about it today. Have a great day, guys, and I appreciate your business.